Welcome to Subramani. Continuing my process of portfolio building, we come to a very important stage of how do I evaluate a company. So first is I look at very dull, old, boring companies, something like a Carborundum Universal. Why am I giving you that? Because recently the results have come and the results are superb. I've been holding this share since I think 1986 or 87. So which makes it a 36 year holding. Very few people have this kind of patience. 36 years people think is a lifetime gone, right? Company has been giving good results. So what do I look for? I look for dividends. I look for increasing dividends over 5 years, and I look also for good return on capital employed, good return on net worth. One another important criteria for me is the market share that it has. Does it have a significant market share? Now, if you take the grinding wheel business, two good companies, Carborundum Universal and Grindwell Norton, and then there are the others, but largely these two companies are very good, well managed, they fight for market share well, and they almost have a 50-50 kind of a market share. I'm exaggerating, but both of them would have equal market share. Both companies are good. So what happens is you tend to like some companies. So do I have Grindwell Norton? I've had Grindwell Norton many times in the past. I trade in Grindwell Norton. Carborundum Universal is something which I've been holding for a very long period. I still might trade, but it is largely a keep it kind of a portfolio. So when I look at dividends, I also look at whether the dividends are sustainable. The payout has to be more than 30% and less than 60%. Sometimes I don't care about payout if I think the company is anyway going to be reinvesting the money in more business, like in Indigo or a Zomato. I don't expect to get dividends out of them. So that's a different criteria. I have both objective and subjective criteria, like for example certain geographies, certain communities, certain businesses I do not touch. I don't want to talk about geographies and communities, but certain businesses where I think there is excessive government control, it's not a place where I would like to be, like alcohol business and fertilizer business, and certain businesses which is a personal bias, like for example I feel that ITC spreads cancer, so I will not have ITC in my portfolio, and that is a new one, right? I've been last maybe 7-8 years I have not held ITC, and I will not hold ITC. That's all. That's a principled decision that I have taken. So So one more criteria could be, when I look at the earnings, I see how it has developed over the years, how it has increased its market share over the years, or what really sustains the business. And is it a business where I am worried that many other investors won't invest? For example, Coal India and NTPC, I know very many companies talk about ESG and they will not invest in the coal business. That does not bother me. I am not too much worried about ESG because I think ESG is just a marketing gimmick done by some companies in the US. So yes, these nomenclatures don't really matter. I also see whether the payout is sustainable, because any payout between 30% and 60% seems to be sustainable. But some PSUs are forced to borrow and pay dividends. That to me is a red flag. I'm not too keen on such companies. I also look at the forward dividend rather than the backward dividend. Let me give you an example. Coal India, for example, is paid 21 rupees dividend last year. So at 210, it's a great buy, right? There's no doubt about that, 10% dividend yield. But the worry is with falling coal prices and increasing individual costs, salaries and wages costs, I don't see that the dividend can be sustained at 21 rupees. Maybe the dividend will come down to 18, 19 rupees. I would still be happy buying it at 230, but it is a little scary whether the dividend is sustainable. So sustainable dividend is very important, and you have to anticipate that the dividend will go down. Now there is nothing called reversion to the mean for an individual share. An individual share can go down, it can go up. For example, BHEL, I have sold the share at 300 rupees sometime in 2007, I think. I bought it back recently in 2020 or 21 at 25 rupees, and I bought again at 80 rupees, right? So some of them you look at all these criteria, ROC, RONW, dividend payout, everything, and also you look at some potential, what can happen and what can't happen. So some of these shares I've been holding for a long time. Some of these shares I've been buying and selling. PSU I've been holding some for a long time, and some I like to sell off. Indian Oil I've been holding. I sell off Indian Oil at 120, 130, but I'm very happy buying it at 78, 79. So I also do this kind of a thing. So is the EPS sustainable? Is the dividend sustainable? This is also a very important thing. Don't just go by the dividend yield and say, wow, this has got 11% dividend yield, I'll buy it. It may not be able to sustain it. So you have to see sustainable dividend yield over long periods of time before you put it in your portfolio. I also do qualitative assessment of companies, seeing how the companies manage, seeing how the family fights, doesn't fight, whether there has been a change of auditor, any big change of philosophy, whether they are entering some new business which they don't understand, right? All these things are very important to know, because in the long run these things will matter. So family managed, well managed. I don't like companies which are totally professionally managed, like Larsen and Toubro, Axis Bank, or ITC. ITC is professionally managed, but it is run by the bureaucrats. So it's always a worry that there is somebody out there in the bureaucracy who is dictating terms. However, in case of Axis Bank, now the bureaucracy is out. It is no longer a PSU holding company, right? Suti has sold out its shares. ITC, Suti is out, but LIC is still there. Larsen and Toubro, Suti is reduced its stake, but LIC is still there. So these are almost PSU in terms of their shareholding. Government has a lot of shareholding. So to me, that's not a very great thing, but I hold L&T and Axis Bank. So that is just a caveat for you. So subjective criteria, market share, is it increasing market share? So just because of market share, I may or may not like the numbers. I have Maruti. Market share helps me hold on to Indigo. I'm convinced that a Zomato business model will stay. So these are some of the things where the criteria of ROC, RONW, dividend payout, some of that may not be applicable or may not meet that criteria, but the qualitative criteria forces me to hold this in my portfolio. If 100 cars are sold, 60 cars are Maruti, and that's a huge market share. If 100 air tickets are bought, 60 are from our Indigo. To me, that's a very important thing. Does Zomato have competition? Yes, there is Swiggy, and the government is likely to come out with something like that. So yes, there will be competition, but I think the home food delivery business is here to stay. So is grocery, etc. So I think that business is here to stay. So therefore, I'm building a portfolio. But believe me, I have a 10-year view. If you have anything less than a 10-year view, these are not good businesses to be in for you. But this is the criteria which I use for assessing which companies to buy. Thank you. I have been talking about company performance evaluation before buying. So one of the things which happens is you do all your valuation, and then you decide that you buy this share at, you are happy to buy this share at 110 or something like that, and the current price is 130. Do I go head on and buy it? Yes, actually I buy a very little bit. You know, you're putting your toes in the water, not even up to your ankle, just putting your toes in the water to see how it is moving, that's all. But it could be a very, very small position, definitely about less than 1%. But it is there, the position is there, and then you are watching what's happening. It's very important. Like for example, if I find a company with a PE of 20 and another company with a PE of 10, I keep looking at it. Maybe the PE of 10 is a commodity company. So if it's a commodity company, you are worried that the growth rate may not happen. It may have grown at 7% over the last 5 years, but then further growth may not happen. And far more importantly, in a commodity company, the dividend may not be sustainable. In a sugar company or a coal company or even in an oil company, what happens if the dividend is not sustainable? So sustainable dividend can happen only when you start looking at the numbers and you say, okay, for example, if I find the PE of 20, dividend of 3 and growth rate of 6%, and another company with a PE of 10, dividend yield of 4% and your growth rate of 7, that's fantastic. I may pick the one in which I do not have a position rather than the one in which I already have a position. Also, one very important thing is I build my position over a long period of time. I am in absolutely no hurry to build it. I'll keep on buying small bits of shares, and I keep giving this example. If somebody tells you this is a good hotel where good South Indian food is available, you don't go and eat 500 idlis, right? You go and eat 2 idlis, and then one day you get your friends along, one day you get your family along, one day you get your business acquaintances along. So over a period of time, I may have eaten 500 idlis in that hotel, but I would never eat more than 2 in one sitting. So that is exactly how I build my positions, very slowly, very slowly. There is no great hurry. It's not that as though the share is going to run away. All shares give you enough time to build a position. So build your position slowly. That's what I do. I'm not even saying that's what you should do, but that's what I do. So sustainable PE, good ROC, good PE, good dividend yield, all that over a period of time, and not being in a commodity business. In the commodity, I buy commodity businesses, but there's a completely different way. The PE does not really help. So once you have done the assessment of companies and you decide when to buy, I mean you then wait. Like I said, you decided you have to buy the share at 110, it's available at 130. I'm in no great hurry to build my position. I'll buy a very little stock at 130 and then I will just hold on. One day when something happens and the price comes down, I may buy it at 110, and if the price goes up 130 to 135, I will go back to my books and re-evaluate, saying maybe this company never gets a lower PE for whatever reasons. I mean, your Colgate and HUL, the PE never goes down. They may be slow in their growth, they may have competition, anything happens, but the PE rarely goes down. When it goes down, it's a good time to be buying, and when it goes up, it's a good time to be selling. It's as simple as that. So I could hold a position in HUL and also sell the position in HUL. Right, if I own say 2000 shares, it doesn't mean I have to keep on holding 2000 shares. Suddenly I may sell off 200 shares or maybe even 50 shares or 100 shares just to test the water, right? So when a company gives you a 66% return in 1 year, right? So Siemens, Cummins, etc. and all have given that kind of a return in the last 1 year. I'm recording this in May 2023. It's a time to sell off a little bit. So let's say I've got 2000 shares of Siemens. What is the problem in selling off 50 shares? It's not as though I'm going to sell out a big amount, but just to test the waters, to say, okay, at 66% return in 1 year, it may not be sustainable, so let me sell and let me keep the money. I may buy something else, or if the same share falls, I may buy that, right? So you keep actively by buying and selling. So then it comes to risk management as to how much should it be there in your portfolio. This is also called portfolio sizing. To me, portfolio sizing is an art. It's also a science. You want to look at the BSE index or something and see how much should be the weightage, or if something is just not there for example, if textile machinery is not there in the index, you would still look at whether textiles are there. If it is not there, then you take a conscious decision saying, okay, I will buy this share, I will buy LMW because or blah blah blah, and I will hold to it. So it's not as though if it is not there in the index, I will not buy it at all, but my weightage will have to be very careful. I have to decide why that should be there and what is the solid reason why it should be there. All these things are suddenly very important in my portfolio building and in my portfolio sizing.